In this next section, through the use of candlesticks, we're going to take a look at a very objective process that will allow you to interpret and recognize when manipulation is taking place at one of the identified technical levels. So candlestick patterns put in context with the smart money trend and identified manipulation levels are the key to interpreting if smart money are active in a specific area. Candlestick patterns can be seen anywhere on a market's chart, but this doesn't mean they should always be traded. So all this means is the reversal legs and the candlestick formations that you have looked at earlier on in the course, they can be seen throughout the price action of all markets and all time frame. Now, if they're not put into context with the smart money trend and also our identified manipulation levels, then they are meaningless. We want to see the specific candlestick formations or the process we're about to go through take place at one of our identified levels. So individual and specific candlestick formations combined with the confluence of support and resistance areas can help to identify stop runs and the accumulation of retail orders. The process of identifying manipulation and stop runs using candlesticks is broken down into 4 specific steps, and we're going to run through each of these specific steps that will allow us to identify manipulation at these important points. The first step we're going to take a look at is the stop run candle. The second is the confirmation candle. The third is the pullback candle, and then ultimately this will lead to trade entry. So step 1, the stop run candle. So when the extreme low or high or an identified manipulation zone is penetrated by a minimum of 3 pips, smart money have potentially initiated a stop run. Okay, so once we've identified a manipulation zone or a confluence of technical indicators that are falling within a relatively narrow price range, and we see price action penetrate the zone by a minimum of 3 pips, this is the potential start of a stop run. And in terms of the stop run candle, this is the only criteria, and that criteria being the violation of the identified area by 3 pips. So if we look at this example, we have the stop run candle and we have the manipulation zone, which is represented by these 2 lines, and this hammer has been thrown through the manipulation zone and it's violated the zone by a minimum of 3 pips. So we would label this candle as candle 1, and this will become our stop run candle. Okay, so the candle doesn't have to be a hammer. As in this example, we see a solid green bar to the upside, which again has penetrated our manipulation zone by 3 points. And again, we'll simply label this as number 1, and this will be our stop run candle. So very simple and very straightforward. The only criteria for the stop run candle is that it violates the identified area by 3 pips. The second step is the confirmation candle. So to confirm that a stop run has taken place, the body of the following candlestick should close below or above the body of the stop run candle. It is essential that the body of the confirmation candle closes within the last third region of its high to low range. And examples of this will be in the candle formations that you've looked at, such as bullish and bearish engulfing patterns, and also bullish and bearish train tracks, where the second candle closes below or above the body of the first. And this is simply to ensure that smart money are following through on the stop run. We should expect to see evidence of institutional buying or selling pressure entering the market. So once smart money have initiated a stop run and they're buying or selling into this pressure, the following bar should be the evidence that they have achieved their goal. So if we see a stop run of the highs where smart money are inducing buyers, and we see smart money selling into this buying pressure, then the following bar should reflect this, and we should see a bar which closes in its lower third region and in the opposite direction of the stop run. So in this example, we have the stop run candle, again represented by the number 1, and we have a valid confirmation candle. So we have a bar which closes lower than the body of the stop run candle, and also it is closed in its lower 1/3 region. And a simple way to confirm whether a candle has closed within its 1/3 region is simply to measure the high to low or low to high range of the candle and then chop it into thirds, and you want to check that the candle does close in the lower 1/3 region. So in this second example, we have an example of a invalid confirmation candle, and in this case, after the stop run candle has penetrated the manipulation zone, the second candle fails to close in its lower 1/3 region, and in this example we can see that it closes at around half of its low to high or high to low range. Now, if the candlestick following the stop run candle fails to confirm and has a higher or lower body, then this becomes the new stop run candle. So in the case of a bullish stop run, we see a stop run of the lows, and the second candle fails to confirm higher and it produces a lower high. This candle will become the new stop run candle, and we will label this as candle 1. In the case of a bearish stop run, where we see a stop run of the highs and the second candle fails to confirm down, but we see a higher low, then this again will become the new stop run candle, and we will simply label this as candlestick 1. So when this occurs, the following candle's body will have to close beyond the body of the new stop run candle, and the confirmation, just like in the first case, will have to be within the last third region of its high to low or low to high range. So this is something that you will see in the candlestick formations known as the morning star and also the evening star, where we have a bar to the up or downside, we then have an inside bar, and then the following bar will close beyond the body of the inside bar, and in effect this will potentially allow the trader to confirm and enter the trade at a better price. And this is simply because the new stop run candle will be closer to the manipulation area. So in this example, we have our stop run candle which has penetrated our manipulation zone by 3 points, and the second green bar fails to confirm, meaning that it fails to close above the body of the first stop run candle, and in doing so creates a lower high. So because we've seen a lower high and the failure of the confirmation of the first stop run candle, we simply label the second candle as number 1, and this will become our new stop run candle. And from there the process is exactly the same. The following candle will have to close beyond the body of the first or the new stop run candle and within its higher or lower 1/3 region. And in this case we can see the second bar has confirmed up, has closed within its higher 1/3 region. So this would then validate the stop run, and we would be looking for a pullback, which we'll go into in a second, which will be bar 3, and then ultimately entry into the trade. In this next example, this is bearish stop run, where we see candle 1 has penetrated the identified area by 3 points. Now this second candle fails to confirm down and we get a green bar to the top side, but in the bearish example we want to see a higher low. Okay, so this green bar has not created a higher low because it's opened at the close of the first bar, but then the next bar is a move to the downside and we see a higher low created within the market. So this will automatically become our stop run candle. Now it's not a requirement that the new stop run candle has penetrated the identified manipulation area. The fact that we already have a stop run of the area means that the smart money have already absorbed the orders and we're simply waiting for the confirmation of the run. Okay, so once we see the lower high, we will label this as number 1, the new stop run candle, and then the next bar confirms down. We see an aggressive move to the downside which closes within its lower 1/3 region, and then ultimately we're waiting for the pullback and entry into the trade. So very simple process. If the confirmation bar fails to confirm down or confirm up, we're simply going to wait until the confirmation occurs. But if in a bearish example we see a higher low, this new candle will become our new stop run candle. And in the case of a bullish stop run, if we see a lower high created before confirmation of the stop run candle, this will become our new stop run candle. Now, one guideline we do abide by here at Trade Simple, Trade Smart is if the confirmation bars criteria is not received within 4 to 5 bars after the stop run candle, and that can be the original or the new candle, the potential trade should be avoided or a second test of the level should be waited for. Okay, so once you've got your original stop run candle, if there is no new stop run candle which develops during the price action, come 4 to 5 bars after, if there is no confirmation, then we would generally void the trade. Okay, now what you can wait for is a second pass at the manipulation zone. So in the case of a MRW formation where we see the original penetration of a level and then we see a bounce in the opposite direction, and then smart money comes back for a second pass. So if you are in a situation where you've seen a stop run but there is no confirmation, then you may choose to eliminate the trade altogether after 4 to 5 bars or wait for a second pass forming the M or W formation. And guys, this is just a guideline, something that for experience we have found works for us. We have found that smart money will tend to work an area for around 30 to 90 minutes. But obviously there are many exceptions to this rule depending on the climate of the market. So this is something you can trial and error, but generally 4 to 5 bars after a stop run candle, if we don't see the confirmation criteria met, we would generally void the trade or look for a second pass at the level. So if you take a look at this example, we see the stop run candle which has violated the manipulation zone as number 1, and then the 4 bars following have no confirmation to the downside. There is also no lower highs which have formed, and by candle 5 we would be voiding the trade. Okay, so we'll be looking for another opportunity elsewhere, or alternatively we'd wait for a higher low to enter into the market, or we'd wait for the M formation to form, and then we'll be looking for a new opportunity with a new stop run candle. So the third and final candle to identify in the process is the pullback candle. So once we have confirmation of a stop run, we can enter a trade if price is a maximum of 15 pips from the recent high or low. And in effect, this will place a 20 pip stop, which is common for most retail traders, a minimum of 5 ticks above the most recent high or low. Okay, so it's very common for price to pull back after a stop run and confirmation candle within 1 to 3 bars. So once we've seen the stop run of the highs or lows and we have a valid confirmation bar, so we know that the absorption and manipulation of retail orders have taken place, there is generally a pullback within 1 to 3 bars of the confirmation. Now, because many times the confirmation candle can take us some ways away from the most recent swing high or low, the pullback candle allows us to get in at a better price and also allows us to secure a stop loss in a relatively safe place. So once we see the pullback candle occur, it's very often that it will return to the body of the stop run candle. And this is a good guideline for those of you who have trouble in determining how far the pullback will be and when to pull the trigger and enter the trade. The general rule of thumb is that the pullback candle at some point will return to the same level as the body of the stop run candle. And this price behavior will most often allow you to take a trade within the 15 pip maximum requirement zone or better. Okay, and in terms of the stop placement, this protection is essential because many times smart money will decide to make another pass at the recent high or low. And we've seen this whilst we looked at the M and also the W formation. If there are a second build-up of retail orders above the high or the stop run low, and smart money decide to make a second pass at level and form the M or W formation, the 5 pip minimum requirement is a good guideline and a safe bet in terms of keeping us in the market and in line with the smart money trend. So in this example, we have the stop run candle labeled as 1. We have the confirmation candle down, which closes within its 1/3 region. And then we have our third candle, which closes within 15 points of the high. And also, as you can see, returns to the body of the stop run candle. Okay, so as we saw the pullback occur and we saw it entering to the region of the stop run candle's body, we can be confident in selling into the market and placing our stop a minimum of 5 points above the recent high. In the second example, where we had the original stop run candle and then we formed a lower high to form our new candle, we had our confirmation to the upside, and then our third candle was our confirmation, and we saw a pullback again, which must be within 15 pips of the low. In this example again, we saw a return to the body of the new stop run candle, and this will allow us to then buy into the market and place our stop loss a minimum of 5 points below the stop run candle or the most recent low. So the closer to the recent high or low you can enter, the greater the stop loss protection and entry will be, but could result in missed opportunities if no significant pullback occurs. So sometimes, guys, you will see that you receive a confirmation candle of a stop run, but no pullback occurs and the market simply runs off and the trend unfolds. In situations like this, if you're always waiting for a pullback, you may miss many trades. So many times the close of the confirmation bar will be within the 15 pip maximum criteria. this can allow you to enter a trade without waiting for a pullback. So if you have identified a stop run candle and you've seen the manipulation take place in an identified area, and you receive a confirmation up or down, and for example, if the confirmation candle's close is within 10 points of the highs, then you can execute the trade immediately before the pullback occurs, and you would have a stop loss 10 points above the most recent high or low. Okay, so if your confirmation candle's close is within the 15-point minimum criteria, you can enter the trade because your stop loss will still be within the 5-point range of the extreme high or low. Okay, so in this first example, we're looking at the euro dollar, where we have identified a high probability area for manipulation. This zone includes the high of the Japanese session. We also have the 0.236 internal retracement of the previous day's range, and we also have the 200 moving average. Now, as smart money begin to move the price in the London Open against their intended direction, we see the stop run unfold. So in terms of our zone, we have a stop run candle which penetrates the bottom of our zone by a minimum of 3 pips. And remember, this is the only criteria for the stop run candle. The identified zone must be penetrated by a minimum of 3 pips. And we can clearly see that this candle was an aggressive move through the zone, and we can see from this long wick that smart money began to sell into this buying pressure. So the second bar we want to see after the stop run candle is our confirmation candle, and with the confirmation candle we have 2 criterias. We want to see the close of the confirmation candle close beyond the body of the stop run candle. So in this example, we can clearly see the close of our confirmation candle is well below the close of the body of the stop run candle. Now, the second criteria is that the confirmation candle closes within its last third region, okay, or its last 3/3 region. So in this case, we simply measure the range of the candle, and this candle has a 4-point range, and if we go to the close, we can see that it closed at the 4.1 mark, so well within the lower third region. So this would qualify as a confirmation candle. Now, once we receive that, we have one of 2 choices. We can pull the trigger if we have the confirmation close fall within that maximum 15 pip range from the highs. So if we look at the low of the candle and we measure the high, we have a difference of 7 pips. So if we were to pull the trigger and sell into this market, our stop loss will be placed with a 20 pip stop, 13 points above the most recent high. Now, having a stop at that kind of level should protect us against both the M and also the W formation. So for example, once we've placed our stop 13 points above this high, if smart money see retail orders begin to accumulate above this level, they may decide to throw the M formation, take out the high of the previous stop run, and then begin the trend. And if this happens, we always want to protect ourselves with a stop loss which is as far away from the most recent swing high or low as possible. Now, if we don't want to pull the trigger once the confirmation bar has closed, or it doesn't fall within that 15 pip maximum range from the most recent swing high or low, then we can wait for our pullback. And in this example, we had a small pullback, which was 2 bars after the confirmation candle, and then we had a minor 3 bar pullback a few bars later. So in both of these examples, we would just simply measure the pullback, and as long as the pullback fell within that 15-point maximum range, we will be able to pull the trigger and oftentimes get a better entry level and also a greater stop. So in both of these examples, we have the minor pullback of the 3 green bars, which is 7 pips from the highs, which will result in a 13-point stop. And also we have a 8-point range from the minor swing, which would result in a 12-point stop above the stop run. So in both cases, you can again either wait for the confirmation or you can wait for the pullback, but as long as both fall within that 15-point maximum range from the extreme high or low, you can pull the trigger. And remember many times that the pullback will not occur and you may miss some trades. In this next example, again, we're looking at the euro dollar, and I've marked out a potential manipulation zone, which is the high of the Japanese session. We have a rally coming out in the London range, and then the market begins to turn to the downside and enters into the opening of the US session. Now, during the open, smart money throw a stop run candle which penetrates the high of the Japanese range by a minimum of 3 points. So once we've seen our stop run candle, what is the criteria for the confirmation candle? Well, we want to see a candle that closes above the body of the stop run candle and also closes within its last 1/3 region. So in terms of the second candle, we can see a close above the body of the stop run candle, and then to measure whether the candle closes within its 1/3 region, we're simply going to measure the range, just around 11 points, and then we're going to look at where the market closed, and it closed around the 9.8 mark of its range. So it closed within its last 1/3 region, so this qualifies as our confirmation candle. So again, once you receive this, you have 2 choices. You can pull the trigger straight away if the close of the confirmation candle is within that 15-point range of the lows, and in this example it's at 12.5. So with a 20-point stop, we would have a stop loss which would be 7.5 points below the most recent low. Alternatively, you can wait for the pullback candle, and in this example we get the pullback immediately after our confirmation, and we can see that the body of our pullback candle returns to the body of the stop run candle. And this is something that happens very regularly. It's not something that you're going to see all the time, but it's always a good guideline if you're hesitant as to how far the pullback candle will retrace. Very often it will return to the body of the stop run candle. Now, if you had got in at the extreme of the pullback, the difference between the most recent swing low and the pullback is only a difference of 6. So if you'd waited for the pullback in this example and you'd place your stop, you would have a 14-point gap between your stop loss and the most extreme low. So the pullback can be advantageous to wait for, because you can get in not only at a better price, but your stop loss and protection against a second or even third pass at the lows will have a greater range. Okay, in this next example we're looking at the dollar yen, and we've identified 2 high probability areas for manipulation. We have our first zone, which is made up of the current day's Asian lows. We have the previous day's 0.382 low to high range, and we also have the 200 moving average. So we have 3 technical levels which make up our first high probability zone. Our second zone is made up of 2 levels where we have the 0.618 internal retracement of the previous day's range, and we also have the low of the previous day's US session. So 2 high probability areas that we've identified. Now, as the accumulation of the Japanese session comes to a close and the London session opens, we see that we have our stop run candle which penetrates our zone by 3 points. Okay, so as soon as we see our stop run candle, we're going to be looking for confirmation, which we don't receive on the next candle, but on the next candle we receive a lower high. Okay, so because we receive a lower high, this becomes our new stop run candle, and then the next candle closes above the body of our stop run candle but doesn't close within its last 1/3 region. So we've received no confirmation to the upside, so we would not be entering the trade at this point. The market then comes down quite aggressively and then heads towards our second zone. So in regards to the second zone, we have our stop run candle which has penetrated our zone by 3 points. The next candle fails to confirm and close above the body of our stop run candle. So as we know by now, because we have a lower high, we have a new stop run candle. Okay, so we'll be looking for a close above the body of our new stop run candle and a confirmation that closes within its last 1/3 region before we consider entering a trade. And we get this on our next candle where we have a strong move to the upside. The body of the candle closes above our new stop run candle and also closes within its last 1/3 region. So checking the distance from the confirmation candle to the most extreme low, which in this case is the same candle, is just 8 points. So that falls within our 15-point maximum range. We don't really see much of a pullback in the candles following our confirmation, but in terms of the 15-point range, even if you had got in on the second candle after confirmation, you still would have been able to enter the trade and have just a 15-point difference between the low and the candle's high. So once we see that evidence of manipulation and smart money have absorbed the retail orders, we can see that the market moves in a very rapid trend to the upside, and we would be in line with this trend. In this next example, again, we're taking a look at the dollar versus the yen, and by now the process should be becoming a lot more clearer within your head. So in this example, I've marked off the Asian high for the current day session, and at the bottom end I've marked off the low of the previous day's session. So coming into the US session on the current day's trading, we have our stop run candle that penetrates the high of the Asian range by 3 points. We then fail to confirm down, but we produce a higher low in the form of the second candle. So this becomes our new stop run candle, and then we get our confirmation to the downside, which closes beyond the body of our new stop run candle and within its lower 1/3 region. And then finally, candle 4, we have that pullback that pulls back to the body of the new stop run candle. Okay, so very simple, very straightforward. We have the stop run candle, we then had a higher low, so this becomes our newer stop run candle. We then had our confirmation to the downside, and then our pullback candle. If we look at what takes place at the lows, again we have our stop run candle, which is quite an extreme candle that pulls beyond the lows of the previous day's session by more than 3 points. We fail to confirm to the upside, but we get a lower high, and because we've got a lower high, this becomes our new stop run candle. So once we receive this, we'll be looking for confirmation, and we receive this in our third candle, where we have the body close within its upper 1/3 region and also above the body of our stop run candle. We don't receive a pullback on the next candle, but on our third candle after the stop run we receive a slight pullback that again pulls into the body of our stop run candle. Okay, so by following this simple candlestick process that you have learnt, it will allow you to interpret and determine whether manipulation is taking place at an identified level. Now, this is very important because on a day-to-day basis, you're generally going to have around 2 to 3 potential manipulation areas that you will identify. Now, an important note is if an identified manipulation area has 2 candles both open and closed beyond its zone, the level will be voided. Okay, so you've identified a manipulation area and you have 2 candles that both open and close beyond its zone. This will void the area as a potential manipulation zone. And when this occurs, the next high probability manipulation area identified on the chart should be the next target where smart money will move prices to. So in this example, we have a manipulation zone represented by the black line. We have our stop run candle, our candle 1, which penetrates the zone by 3 points. The next candle fails to confirm down. We then have a new candle develop, which forms a higher low. So this becomes our new stop run candle. But the next candle, candle B, also open and closes above the manipulation area. Okay, so we've got 2 open and closes in this example, both A and B, that have opened and closed above the manipulation zone, and the same is true in reverse. If we have a manipulation zone on the downside and we have 2 candles open and closed below the identified manipulation area, we will void this area as being a potential zone. Okay, so in this example, we'll simply be waiting for the prices to be pushed to the next identified level, and then we'll be looking to follow the same process to identify whether manipulation is taking place. So in this example, we're looking at the euro dollar, and we've identified 2 possible manipulation areas. Now, if we take a look what happens at the first zone, we see that smart money pushes prices beyond the level, and we receive our first stop run candle. We then have a failure to confirm, which produces a lower high, so this becomes our new stop run candle. We're then looking for confirmation, which we don't receive because although the candle closes above the body of our new stop run candle, it fails to close within its upper 1/3 region. The market then returns back into the zone, and then below the level we have 2 candles that open and close beyond the zone. Okay, so once this occurs, we're going to void our first manipulation zone as a possible area, and we're going to be looking for manipulation of our next identified area. So as smart money pushes prices to the downside, we have our stop run candle, which penetrates our zone by 3 points. We then have failure to confirm. We then get a candle that produces a lower high. So this becomes our new stop run candle. And then finally we receive that confirmation to the upside. And then we receive 2 pullbacks that will allow us to trade in line with the smart money trend. In this next chart, we return to our previous example on the dollar yen, where we had identified 2 potential manipulation areas, and we ultimately saw manipulation take place at our second zone. Now, if you look at the price behavior that takes place after the stop run candle at our first zone, we had 2 candles that both open and close below our identified level. Okay, so as soon as this happens, we'll be looking towards our second identified zone as our potential manipulation area. So it's very simple and very straightforward. If you see 2 open and closes beyond your identified level, you're going to void the manipulation area, and you're going to look towards the next high probability identified zone as a potential area of manipulation. Okay, so you should now have a good understanding as to how to interpret and recognize when manipulation is taking place at our identified high probability zones. Now, in terms of the trade entry, we would generally take entry once we receive the confirmation candle or on the pullback. Now, many traders are more conservative and will want that insurance or further reinforcement and confirmation that the manipulation has taken place and that the trend is about to unfold. And we can apply moving averages to add extra confirmation to manipulation, and you can do this by using the simple moving average crossover system. So moving averages can confirm both stop run candles and also stop run formations, or be used to enter a trade against a manipulation area. So there are those traders out there who, once they've identified manipulation areas and they receive a moving average cross, will simply enter the trade. Now, at Trade Simple Trade Smart, we first want to see the evidence shown through candlesticks, and then we will typically use moving averages to confirm what we have seen. So many conservative traders may choose to only enter a trade once both a confirmation candle and moving average cross have been received against an identified zone on the 15-minute chart. So many traders will want to have the candlestick formation take place first, and then see the moving average cross in the direction of the expected trend. Okay, and this will totally depend on your level of experience, your aggression to trading, and also your risk appetite, because getting in on a moving average cross will tend to get you in at a worse price than the candle formations, but you will have better or more confirmation. So the moving average crossover technique requires the plotting of 2 different moving averages on the lower 15-minute chart, a fast moving average and a slow moving average. Now, once you have chosen your moving averages, it is essential that your settings to generate your moving averages are set at closing prices. And that is a very important point, because moving averages are notorious for crossing and uncrossing. And because they're dynamic and they move in line with whatever price action is doing, if you don't have them generated from the closing prices of bars, then you will be prone to many false flags and many false signals to confirm your manipulation. So when you're selecting your moving averages, just ensure that they are generated through closing prices. So the basic idea behind the moving average entry confirmation is when the 5 faster moving average crosses above or below the 13 slower moving average. After entering a manipulation zone, the shorter term trend has taken lead over the longer term. Okay, so all we're looking for is once the identified manipulation area has been entered by price action and we have seen the correct formation to confirm that absorption and manipulation of retail orders have taken place, we're simply going to look for the five faster moving average to cross above or below the 13 moving average, and this obviously depends on whether we're in a bull or a bear trend. In a bear trend, we'll be looking for the 5 to cross below the 13, and obviously in an uptrend we'll be looking for the 5 to cross above the 13. Now, when moving averages cross, because they are notorious for crossing and uncrossing, this may only be temporary. So when you see an initial cross, it doesn't necessarily mean that the cross is going to remain. The crossover of the moving average is simply a strong indication that the trend has now begun to move in the direction that we're expecting against our manipulation zone. Okay, so we're simply using it as an indication that the short-term momentum of the market has turned and that the trend is now beginning to move in our expected direction. In this first example, we're looking at the euro sterling, and we've identified a high probability area of manipulation, which includes the 0.236 internal retracement and also the highs of the Asian session. Now, for clarity purposes, I've removed both the 50 and the 200 moving average. So in terms of the manipulation process and the candlestick formations, we see that we have our first stop run candle, which penetrates our identified area. We then have a higher low enter into the market, so this becomes our new stop run candle, and then we receive a nice confirmation bar which closes beyond the body of our new stop run candle and also in its lower 1/3 region. So in terms of the candlestick formation and identifying whether manipulation has taken place at this level, we can now look towards a moving average cross to reinforce and confirm the manipulation. So in terms of adding the indicators to the chart, we're simply going to go to our moving averages, and we first want the 5 moving average, and I'm going to make that purple. And again, you must make sure that when you select the moving averages that they are set to generate through closing prices. Okay, that is essential. And in terms of the type of moving average that we generally use here at Trade Simple, Trade Smart, we tend to use the exponential as opposed to the simple. Okay, so we're using the 5-period exponential moving average, which is based off closing prices, and I'm going to select that and put that on the chart. And then the next indicator that we want is our 13 moving average, and I'm going to make this black, and again just make sure that it's an exponential moving average and also it's applied to closing prices. So that's plotted both the 5 and the 13 moving average, and straight away if you look at the manipulation area on the close of the confirmation bar, we receive a cross of the moving averages. We see that the 5 moving average, again represented by the purple line, crosses below the 13 moving average. And as the trend unfolds, you can see that they do not recross. Okay, so once manipulation had taken place at our identified area and we received our confirmation bar to the downside, for extra confirmation we can look towards the moving average cross of the 5 and 13, and once we see this cross occur, those more conservative traders can then pull the trigger and enter into the market. Now, a point I will make, even though we generally will enter the market once we've received the confirmation bar or a pullback, we do generally have the 5 and 13 on the charts simply to reinforce our trading decision. It's always nice that once you've entered into the market and you see that 5 and 13 cross, that it adds that extra bit of confidence to your trading. Okay, now you won't always get the cross so close to the manipulation area. As I said before, the pay up that you pay for receiving the extra confirmation by having both the candlestick formation of manipulation and also the moving average cross is that you would generally get in some ways away from the manipulation area. But in this instance, we had the cross take place on the close of the confirmation bar. So very simple and very straightforward. We're simply looking for a cross of the 5 below the 13 moving average in this case to reinforce and confirm that manipulation has taken place at our identified level. In this second example, we're looking at the dollar versus the yen, and I've marked off the current day's Asian lows. Now, one thing to notice is when a market is trending, that the 5 and the 13 moving average will generally have a nice wide separation to them. So as you can see in this downtrend coming out of the end of the Japanese session and during the London session, we have a nice wide separation between the 5 and the 13 moving average. And this is just to show that the short-term trend of the market is down. As we make the reversal and we're heading towards the open of the US session, we have a cross of the averages, which shows that the short-term direction of the market is up. And then during the open of the US session, we see a stop run of the Japanese session lows. So we see our stop run candle that penetrates the level by more than 3 points. We then have a failure to confirm because the confirmation candle does not close below the low of the stop run candle. We receive confirmation on a second candle, but then we receive a moving average cross once we have a third candle to the downside. So once we saw a close of this third candle and we had the moving average cross, we can then enter into the trade and be back in line with the smart money trend. And again, notice that as the trend unfolds, that the separation between the two moving averages are nice and wide. Okay, so again, for those traders who are comfortable with just trading the candlestick formations, you would be pulling the trigger in and around the second bar after the stop run. And for those of you who want that moving average cross, you'll be getting in a little worse, but you would have that extra bit of confirmation. Now, one thing to point out is after you have a stop run of a level, as you have learned, you will generally receive a pullback of some kind. Now, this is also true of moving average crosses. When moving average cross over, you tend to see some kind of pullback in the opposite direction of wherever they're crossing. So in this example, we can see that once we receive that cross of the 5 below the 13, straight away the next bar is a pullback. Okay, and then 2 bars after we have another pullback. So although you are paying more to receive the confirmation, again you can wait and look to see if that pullback occurs after the crossover. Now, just like with the candlestick formations, the pullback isn't guaranteed. So if you do not pull the trigger on the close of the bar that creates the crossover, then you do risk missing out on the trade. Now, a couple of guidelines to help you when using the moving average entry confirmation system, and that is when watching the moving averages in real time, you will notice that the moving averages can cross and uncross multiple times as price change. Now, this can lead to many false flags and entry to bad trades. It is essential that once the moving averages have crossed, after entering the trading zone, that you wait for the first trading bar or the bar that creates the crossover to close. So the nature of moving averages, especially those of relatively short term, such as the 5 and 13, is because price is prone to swings, that you would generally see the moving averages cross and uncross multiple times as price moves. So the simple rule is once the price action has entered into the manipulation zone and you've interpreted manipulation and you begin to see the 5 and 13 or whatever moving averages that you have chosen cross, you do not accept or confirm the cross until the bar which has created it has closed. Okay, so if you see a cross of two moving averages but the bar which is creating the cross has not closed, you simply do not accept the cross as true. And this simple rule will keep you out of a lot of bad trades. Now, our final guideline is that it's beneficial but not essential that price action is above both the moving averages in a bull trend or below the moving averages in a bear trend once the crossover has occurred. So if you've seen manipulation of buy orders and we're expecting smart money to move the market to the downside, then once you've seen manipulation take place and we get that crossover of the two moving averages, it is a good measure of momentum if the price action is below the moving averages. Okay, and the opposite is true in a bull trend. If we see the manipulation of sell orders into the market that smart money are going to buy into to unfold a bull trend, once we've interpreted manipulation take place through the candlesticks and then we receive a moving average cross to the upside, again it's a good measure of momentum that the short-term trend is going to move to the upside if the price bars are above the moving averages when the cross takes place. But again, this is not essential, but it just adds that extra bit of reinforcement and confirmation that the short-term trend is moving in our expected direction. So in this example on the sterling against the dollar, where we have the manipulation of the Asian lows, and we can see our stop run candle and also our confirmation candle. Once we receive the cross of the 5 above the 13 moving average, notice that the bar which creates the cross is above both of the moving averages. Okay, so we can see that momentum to the upside, which is the expected direction after the manipulation of sell orders into the market, is taking place because we have both manipulation, we also have a cross of the moving averages, and price action is trading above both of our averages. The same is true in a bear trend. If we look at our previous example on the sterling against the dollar, once we had the stop run and confirmation of our Asian lows, and we received that cross of the two moving averages, the candle that creates the cross and the price action subsequent to manipulation are all below both of the moving averages. So this is a guideline, it's not a set in stone rule, but the more evidence and the more confirmation that you receive that the short-term trend of the market is moving in our expected direction, the more successful and the higher the success rate of your trades.